And we've got a couple big stories making news in the grain markets this week, too. This is all in advance of next week's big USDA report. Author and analyst Elaine Kub joined me this week to make sense of a couple things that could impact your bottom line. Elaine, I want to talk to you about this article you wrote for DTN, How to Handle Inverted Old Crop, New Crop Spreads. So explain to us what we're seeing with the spreads and why that's important.
Well, we may or may not still see prices move higher, but the interesting or the rare thing that's happening is that the deferred prices are lower than the current prices. Typically, in an annually produced commodity market, there's carry in the market to reimburse people for storing that grain. So higher prices 3 months from now than you have today. And that's not the case. Things are inverted. The market is screaming for the grain. It says that it wants owners to bring that grain to market and not to store it. But that makes sort of a frustrating scenario for farmers that are looking at the new crop, right? If you have old crop corn at $5.40 cash, but new crop corn at only $4.50, it feels, very frustrating and unfair. Why can't I sell my new crop grain for this higher price that's available now? But it doesn't matter how much grain we're going to produce in 2021. We may have 17 billion bushels or whatever the number may be. None of that corn can come to the market today to relieve the supply pressure that the market is feeling. So there's just really not a lot that anybody can do about to bring today's prices forward to the new crop marketing.
The record high inversion happened in the summer of 2013. Do we know how extreme things could get this year?
That's right. When spreads are inverted like this, things get wild. When spreads are in a normal carry, you kind of know that spread is never going to get more than 8 to 10 cents. But when it's inverted, it could do anything. And you're right to think back of the summer of 2013. The futures market was inverted. I think the high was $1.93 per bushel from the old crop futures to the new crop futures. Old crop futures were $6.85, and the new crop futures were $4.90. So something similar could happen now. I mean, our inversion is 80 to 90 cents, but it can trade wildly, 10 cents different any given day, because these are two separate markets, and they're just really not really attached to each other from a supply and demand perspective. And also keep an eye on basis. I think back to that summer of 2013 timeframe. It wasn't just the future spreads that were wild. It was really hot basis trying to get that old crop corn to the market.
What's the best approach to marketing that crop?
Well, for the person who still has old crop corn to sell, or old crop soybeans for that matter, which is also inverted, I mean, this would be a fun scenario for them to sit and see what happens this summer. But for folks who, and this I think is the majority of farmers who have already sold out of old crop and are only able to focus on new crop marketing now, it's harder and it's more frustrating. But I think you have to just remember that these are two separate markets, and not to get too tied up in whatever the benchmark price is today. This is a totally separate market, and it's hard to do. It's a cognitive bias, it's a psychological trap not to let yourself be influenced by today's prices. But we need to be thinking about the new crop market. And there are reasons to be bullish. There's drought across the Western Corn Belt. There's not ideal growing scenarios to get us going in the spring. So there's reasons to be bullish, but I hope that the reasons people are bullish are not seeing this $5.40 price tag on old crop cash corn.
Okay, Elaine, I want to switch gears now and talk about fertilizer prices too. Why are we seeing such big increases in that area?
Well, it could be a lot of reasons. I mean, one, there's just this expectation that we're going to be pushing a lot of row crop acres, record high row crop acres when you look at corn and soybeans combined. Of the 92, maybe 93 million acres of corn, we'll see what the intentions report says on March 31st, plus 90 plus million acres of soybeans. So together, that creates a lot of, legitimate demand for these fertilizer prices. But also there's this scenario, you could have some sort of COVID logistics going in there. Who knows? It's just sort of the hype of that market.
Fortunately, though, most folks locked in lower prices or prepaid for that fertilizer ahead of time, right?
Yeah, so prices have been churning higher and higher. I think this is the 6th straight week that we're seeing higher fertilizer prices. Anhydrous is 670, starter is 590 something dollars per ton, and they're churning higher $20, $40 a ton each week. So, if you're trying to lock in prices now for the spring, that's a problem. But I think there's evidence that the co-ops and other agricultural suppliers saw a record high amount of pre-inputs paid for last fall. Because we had good crop prices at harvest, folks had cash that they were willing to put down for the 2021 marketing year. And of course, your mileage may vary, but I think industry-wide, I don't necessarily think that we're going to see a huge problem from these higher prices that we're seeing this spring, because I think a lot of these prices were locked in back last fall when anhydrous was more like $4.20 a ton.
And finally today, big USDA report at the end of the month. Give us a preview.
Yeah, you look back in history, and I cannot tell you whether a March 31st report is going to have a bullish or a bearish reaction. There's equal likelihood, right? But I can tell you with some confidence that it usually is a relatively big reaction. The market does tend to move 4 to 5% that day and continue to be either higher or lower a week later. The exception, of course, was last year when the corn market didn't really move at all after the March 31st report. So, like usual, Troy, it's up, down, or sideways.